Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, we're discussing long-term care, what it is and why it matters, and how your marital status can impact your retirement savings. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today we're discussing long-term care, one of the biggest financial risks facing retirees. Ryan, Cole, thanks for joining us today.
Of course.
What exactly is long-term care and what does it cover?
Sure. So long-term care is a form of insurance that covers any stays, extended stays in nursing home facilities, rehab facilities, anything like that. But it can also be extended to even in-home care. So it's really any sort of care that's above and beyond medical necessity care. Typically has to do more with your active daily living is kind of those. So there's 7 different components of that. It's things like dressing yourself, going to the bathroom by yourself, feeding yourself, things like that.
I've heard it's like everything you do before you leave the house in the morning.
Pretty much, yeah. I mean, so
yeah.
they base the need of that level of care based on how many of those you can or cannot do yourself, and then a lot of times it's just about helping that person accomplish those goals.
Yeah, absolutely.
And I would imagine you've had several clients or clients' parents in long-term care type facility needs. Why doesn't Medicare health insurance cover that type of thing?
It's a good question. Medicare will cover stays in nursing homes for rehabilitative purposes. The general rule of thumb is if it is a chronic condition that you're not expected to recover from within a short period of time, then Medicare is not going to pay for that stay because that's going to be considered long-term care, and Medicare essentially is there to pay for short-term care. So let's say you have a hip replacement and you go to a nursing home for a couple of weeks for rehab, they will cover that. But if you're going to a nursing home just because of ailing health and you're not able to care for yourself, that's where Medicare is going to stop paying. And so that's where long-term care insurance or some sort of insurance or your personal assets will be needed to pay for those types of services.
Got it. So Medicare will cover a certain amount, then they say, okay, now it's on your dime.
It's essentially 100 days is what it comes down to.
Until your dime runs out. Got it. Okay. So let's take the long-term care facility and long-term care insurance, and we'll split those two.
Yeah.
In your experience, and I don't need an exact number, you don't own a facility, but what have you seen costs of long-term care facilities cost a month?
Sure. So I've examples that I can pull from my family. The nicer facilities, specifically memory care facilities, tend to be the highest cost one. Those are $10,000 to $12,000, and we're in kind of
a month.
A month, and those are, and we're kind of in a median or lower range of that. If you go, I mean, Alaska is probably the highest range, and those can be up to $30,000 a month, just because the limited number of care providers and the type of facilities they have to provide. So that number it ranges, pretty vastly. And again, Medicare doesn't kick that in for that because they deem it's not medically necessary, which is really their threshold. They think of it more of as a maintenance or quality of life issue, which isn't exactly what it's technically designed to deal with. So the cost can range pretty vastly.
Yeah.
Okay. And now to long-term care insurance.
Yeah.
And now long-term care insurance we're talking about that specific to long-term care, right?
Yep.
And you always hear how expensive that is, which doesn't surprise me if the cost is 10, 12 grand a month.
Yeah.
What do you see a long-term care insurance type of monthly premium look like?
Well, I mean, it depends on what amount of coverage you're buying, because just like with life insurance or any other type of insurance, you can determine what amount of coverage you want to have. So let's say, for example, you want to have $10,000 a month of benefit in the event that you need care, and then you want that adjusted for inflation over the course of your lifetime.
Got it.
It's going to be dependent on your age, but let's say you're in your 60s, because that's often when people start thinking about it, and of course that's when it starts to get much more expensive.
Sure, you're closer to needing it.
Absolutely. I mean, and so I've seen married couples spending upwards of $6,000, $7,000 a year on premiums for those types of policies, which when you compare to $10,000 to $12,000 a month, obviously is a substantial savings. But at the same time, if you're buying traditional long-term care insurance, there's not a guarantee that you're going to get anything from it.
I was going to say, it's a savings maybe if you use it.
Exactly.
And you're in there long enough.
Absolutely. Yeah, absolutely. Because, I mean, you're going to pay those premiums for life. And there's a good, strong possibility that those premiums will rise in the future. They can't
That's right, they're not guaranteed, right?
Yeah, they can't single you out for a rate increase. Like, they can't say, oh, you're now 70 years old, so we're going to make you pay more. But they can go through and they can say, everybody that bought a policy in this time frame is going to have an increase of 10% or 20% of their premium or what have you. And so it can limit some of your options, because if that premium gets to the point where it's unaffordable, which I've actually experienced with a client in the past that had bought it way long ago, long before our relationship began, and she's in her mid 80s now, and it's just every 2 years they're increasing the premium on her.
Sure.
And it's just getting to the point where now she's at the point of life where she potentially needs the coverage.
Right.
And she's getting to the point where she can't afford it anymore. So now she's having to be forced to reduce the amount of benefits that she gets from the policy just to keep the premium from rising.
And now, just so we're clear too, we're going to talk more about other ways to fund for our long-term care.
Absolutely.
We're talking about long-term care insurance, which really the pool of insurance companies offering this has shrunk quite a bit, hasn't it?
Very much so.
And it's, from what I understand too, it's not just the insurance companies' greed, that's driving the prices, but look at the cost of healthcare going up.
Yep.
Medical technology is fixing, lots of ailments every day. So every elderly issue they fix bumps your life expectancy way out. So it's just a tough conundrum for people to deal with.
Absolutely.
What if you need that care and you have no money and no long-term care insurance? What helps you out then?
Sure. So essentially, a lot of the times, unfortunately, it comes down to what state programs are available for you. There is Medicaid to some extent. They'll pay for it, but typically you end up in a state-run facility. You get less choices. It's really just a matter of what is open and what falls into that category. So there is still facilities out there. There are just not as many of them. And then with recent cuts to Medicare and Medicaid, we've seen definitely those facilities are going to fill up faster, and likely a lot of them are going to close because they're not being funded as well. So that waiting list time period is going to continue to increase over time is really what we're expecting and kind of pushing people to expect in the future.
Well, and you could also be in a situation where if you're private paying, whether it be through a long-term care policy or some other means of paying for that care, then you could have, a fully private room and all of those types of things, where if you're on state-run care, that you could be sharing a room, all of those different types
facilities.
of things change. Yeah, absolutely.
Okay. And so one other thing that people talk about is they don't have any money, but I've still got my house. I'm leaving my house to my kids and go on Medicaid. How does the house situation, because you still have value there with a couple, or if it's one passed away and it's a single, how does that pan out?
That actually changes depending on who's living in the house. So if it's a married couple, one spouse needs care, the other spouse is still living in the home, then the home is considered an exempt asset in most cases. So the state can't force you to sell your home if your spouse is still living there, right?
Right.
They can't, they
Kick
can't.
you out.
Yeah, exactly. Sure. However, if let's say your spouse passed away, and now you need care, and there's nobody living in that home anymore, it is possible that could be forced to be sold at that point in time.
Because there's money there.
Yeah, absolutely, and used to cover your care.
Sure.
And there's various different things that people can do to try to avoid that, putting it into some sort of an irrevocable trust or something along those lines. There have been a lot of people that have done life estates in the state of Wisconsin, where essentially you just change the name on the deed to your children, and then you retain a life estate, allowing you to live there for your entire lifetime. But there was a law change a number of years ago in the past that kind of de-incentivized that strategy, where you can still do it and it will still, not allow the property to be sold. But what happens is, after that person passes away, the state essentially runs this calculation to determine how much they collected from Medicaid, and then they can put a lien on that property that the kids would then have to pay if they were to sell the property or anything along those lines.
Right.
So there could be some estate recovery type of things that happen if you do collect any Medicaid dollars for your care.
I suppose, because the state is just saying, use your money before we start kicking in.
Absolutely.
But there's, I don't want to say manipulation, but like if they're watching out for manipulation to say, hey, we still paid, you still had some money, so pay it back.
Yep, exactly.
Understood. All right, stick around, because we're going to get into other ways of offsetting / funding long-term care, since it is a pressing issue.
Yeah.
So after the break, we'll explore alternative and hybrid strategies, so stay tuned.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could step in and make those decisions for you and your family. Through our partnership with Estate Guru, we make the estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our services cost 70% less than traditional estate attorney fees. Contact our office today to get started.
And now back to our weekly question and answer segment.
Before the break, we covered what long-term care insurance is and why it matters. Let's go a little bit further into this.
Yeah.
I would imagine that this has become a much larger topic for people these days. Is that what you're seeing in client appointments?
Yeah, absolutely. People are living longer, as we've said earlier in the segment, and that really just leads to more people needing it. Statistically speaking, that rate has risen over years. I mean, again, it's the same conversation we have with people about Social Security. Social Security's changed because it used to be, hey, maybe collect 3, 4, 5, maybe up to 10 years, and now it's 20, possibly 30.
Right.
Same thing with long-term care. As people live longer, your likelihood of needing that level of care or specific memory care is going to increase. It's impossible for us to expect an 88-year-old to maintain all of their active daily livings and do that, just across the board. There are plenty of people who can, but there are a growing number of people who cannot do those things.
Let alone mow your yard.
Right.
Take your trash down.
Yeah,
all those
exactly.
things.
Yep. So there are different levels of care. We typically talk to clients about the stages that are going to happen. One, it's typically going to be your spouse takes care of you until that becomes too much, and then it might be family members jump in and take care of some additional things. Maybe then you move to a nurse that comes, a couple days a week or every day of the week eventually. And then that last step is really that confined facility, so to speak.
Right.
And those can happen over the course of a decade or can be pretty quick. It really kind of depends on the condition they're dealing with, what's driving the need for that care, whether that's Alzheimer's, dementia, or maybe just a physical ailment. You're just not able to get up and do those things anymore. So there are lots of different reasons to need that care. I think people always think of that early onset Alzheimer's, dementia, that potentially 8 to 10 years in those confined facilities. And that's the worry. That's kind of that nightmare story we hear.
Which is so common.
Right. So it's not right for everyone to need these, but it's becoming more and more common to look at this or look at alternatives because the chances you're going to need that type of care have continued to go up and look like they're going to more so in the future as we continue to live longer.
Right. Now, we talked about traditional long-term care insurance in the first half, which is the offerings are shrinking from insurance companies because it's so hard for them to price and figure out.
Yep.
The cost, as you mentioned, of that premium can go up as you get older and closer to needing it. The healthcare costs are rising. People are living longer, like all these things. But insurance companies have become a little more innovative on how to help you get rid of kind of the use it or lose it or premium risk or all those things. Talk about some of the hybrid policies that are out there that kind of can double dip, if you will.
Yeah, absolutely. I mean, this, I think, from our perspective, from an advisor's perspective, is a more palatable way of planning for long-term care.
Right.
Because, nobody likes, it's no different than any other insurance. We carry it because we have to, right? Our homeowner's insurance,
or it's a
our
luxury
car
to
insurance.
carry it.
Oh, sure, absolutely. And long-term care coverage or protecting against that risk is no different. We're protecting against the possibility of needing it. The problem is long-term care insurance is way more expensive than, say, like homeowner's insurance or car insurance or something like that, right? And so if a client has a concern about long-term care, oftentimes we'll look at maybe a life insurance policy that incorporates long-term care benefits into it.
How does that work?
So basically, it's a whole life or a universal life policy, and it's designed with a rider that's attached to that contract or built into the contract, depending on the company, and it allows you to accelerate all or a portion of your death benefit for the purpose of long-term care. So let's say you can't perform 2 of your 6 activities of daily living, or you have a cognitive impairment of some nature. That might be the trigger for you to be able to collect claim from your death benefit. So let's say you have a $500,000 death benefit, and that company allows you to accelerate, let's say, 90% of your death benefit. So essentially you've got $450,000 that you can use towards long-term care, whether that be in-home health care, assisted living, nursing home, whatever it might be. And so not that these policies are any cheaper than long-term care. In some cases, they're going to be a little more expensive. But the advantage is you're actually investing into something that you know is going to end up going to someone. So either you need care at some point and you're going to use
it or lose it.
Correct.
You're going to use it.
Yeah,
Just
because if you don't end up needing care, let's say you pass away at 85, warm in your bed, never needed care in your entire lifetime, well then that $500,000 death benefit is going to pay out tax-free to your loved ones.
Sure.
So I mean, it's really a dual purpose policy, and it's designed for those people that are concerned about the risk, but they also don't necessarily want to be throwing their premiums out the window at a traditional long-term care insurance.
Makes sense. So I suppose from the insurance company, they're going to pay the death benefit anyway at some point. So if you need it ahead of time, here's maybe a discounted amount or something to offset what you're going through right now.
Yeah.
Now life insurance requires underwriting, though, right?
does.
So I got to be somewhat healthy. There's annuities that do similar things too. How do those generally work?
Yeah, so it's the same concept. So they add these riders that essentially say, hey, you can turn this into income at some point. The difference there is typically they say, we're going to lock this income for life. It may not be specifically geared towards long-term care. Some of them are, but some don't just say, hey, this is an income rider. It's going to guarantee you have at least this much coming in every month, which a lot of times would be enough to cover that care, and says, even if you run out of money, we're going to continue to pay this until you pass away. And so that's a good alternative. The nice thing, similar with the life insurance product, is if there is money left over, that's going to go to your heirs in a lot of those policies, which make it a little bit more palatable than that kind of car insurance type life long-term care insurance that is more traditional, because at least there's a benefit on the other end, and you possibly could get even more money than you would alternatively. So those assets make a great alternative, because typically you think about this, 10, 15 years down the road, not, I'm going to need this tomorrow. So you have time to kind of accumulate, and if you never need it, you still have that source of, kind of growth and income to pull from for something else.
You don't lose it again.
Right.
Yeah.
And that's kind of the biggest advantage you're getting from those products. It's not this, again, car insurance is great when you have to use it, but it also means something terrible happens. So it's the same with long-term care insurance.
Right.
Yeah.
Now we're talking all factual ways of doing this, but I'm going to guess there's a bit of emotional discussion that goes along with a family in this type of thing. How does long-term care planning affect a spouse?
Well, I think peace of mind is really what it comes down to, I mean that's what all planning does. I think is it gives us confidence in what we're doing, and so from a spouse's perspective, knowing that you're not going to bear the full burden to care for your spouse if something happens.
Physically, can you at 88 years old?
Well, exactly. Sometimes that physicality just doesn't allow us to, lift our spouse in and out of bed or in and out of the tub or anything along those lines, and so we may need a professional to come in and help us with those types of things. And so I think it's just that confidence, that peace of mind, knowing that if something does happen, that we have a plan in place of how we're going to compensate for that care.
And how about the children?
Yeah.
I mean, you don't even say it, but my kids will take care of me, but oftentimes that's not a reality you must see as well.
Right. Kids are normally, when you're at that stage, they're still in their careers. They're not retired
Kids,
yet.
sports.
Again, so the chance of them being able to just say, hey, I can come take care of you in the middle of the day all week is pretty unlikely, and it's not something that typically is something they can afford to just put their career on hold or just say, hey, I'm going to retire, 20 or a decade earlier, because we don't know when that level of care is going to be needed or exactly how. But we've seen it, and again, people are having kids older and older too is the other side of this. So they tend to be, the kids might have a much bigger age gap than it used to be for our parents' generations or something like that, where it was maybe 20 years in between. It's not that big of a gap. Now, me personally with my parents, there's over a 30-year gap.
Right.
So it's very unlikely that when they need this care, I'm going to be able to be the one giving it to them.
Right.
Yeah. And also, I see a lot where clients just don't want to be a burden to their kids.
Yeah.
They're like, I don't want to have my kids take care of me.
Yeah.
I want to have a plan in place so that I never create that situation that puts that stress on them.
Good. Well, I appreciate you guys having this discussion with people. I know it's probably an uncomfortable one for people, but families often don't talk about it. So if it wasn't for people like you, it just wouldn't be discussed and would just be a problem.
That's true.
So if you're watching this, haven't had a long-term care planning discussion, don't know where to start, call Buska Retirement Solutions, go to their website. Even if it's something where they could set up a family meeting to discuss it openly or help you get to a better place where you have a plan. Not having a plan for it is also, in fact, having a plan. So do something to move it forward. Appreciate you watching, and gentlemen, as always, appreciate you having me on the show.
Of course. Thank you.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we provide a comprehensive approach to planning your future. We work closely with you to create a personalized, comprehensive retirement plan that reflects your unique goals and financial situation. Our team integrates investment management, income planning, tax strategies, estate planning, health insurance, and Medicare planning all under one roof. That means fewer appointments, less stress, and more clarity as you prepare for life's next chapter. Whether you're just starting to think about retirement or looking for a second opinion on your current plan, we're here to help you feel more confident about your financial future. Call us today at 715-355-4445 or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation. Let's make retirement planning easier together.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management, and today I'm here with my sister and our Vice President, Kaylee Berenson. Today's topic is based on the Investopedia article entitled, "Could Your Marital Status Be Reducing Your Retirement Savings? Here's What to Know."
Well, it's an interesting topic because many people don't realize how much marital status can influence retirement outcomes. And the article points to meaningful differences in saving levels between married and unmarried workers. These differences often extend beyond retirement accounts and into overall household wealth.
According to research highlighted in the article, married workers tend to accumulate more retirement savings than their unmarried peers. The gap appears consistently across both retirement accounts and broader financial assets. This suggests that household structure can influence long-term financial progress.
That's right, and marriage often creates opportunities to combine financial resources. 2 incomes may allow couples to contribute more consistently to their retirement accounts, and shared living expenses can also make it easier to allocate money towards long-term savings goals.
Over time, these advantages can compound. Coordinated retirement strategies may help couples align savings habits and investment decisions. This type of long-term consistency can strengthen financial stability as retirement approaches.
And housing wealth is another factor mentioned in the article. Married households are more likely to build home equity, which contributes to their overall net worth. Now, while home equity is not the same as having retirement savings, it can provide additional financial flexibility later in life.
The article also highlights challenges faced by divorced, widowed, or separated workers. Major life transitions can disrupt financial plans and change household income structures. These changes may create additional pressure on saving strategies.
And that's a great point, Cole, because in some cases, individuals experiencing these transitions may rely on their retirement funds to manage immediate financial needs. And accessing those long-term savings early on can reduce the amount later in life. It can also interrupt that compounding growth potential that retirement accounts are designed to provide.
That's right, and financial adjustments often follow major life events. A divorce may involve dividing assets or taking on new housing costs. Losing a spouse may mean transitioning from 2 incomes to 1, which can impact the ability to maintain consistent savings habits.
Even so, the article emphasizes that marital status alone does not determine financial success. Individuals in any situation can take steps to strengthen their retirement outlook, and consistent saving and thoughtful planning remain key factors in long-term financial stability.
One strategy mentioned in the article is making full use of employer-sponsored retirement plans. Taking advantage of available matching contributions can help increase savings over time. These contributions can play an important role in supporting future financial goals.
Another helpful step is preserving retirement savings whenever possible. Allowing investments to remain in place gives them more time to grow, and long-term growth can play a significant role in building financial confidence for your retirement years.
Absolutely, and gradually increasing contribution levels may also improve outcomes. Even small adjustments made consistently over time can support meaningful progress. Building strong habits can make a difference regardless of your marital status.
And maintaining savings outside of your retirement accounts can also provide flexibility. Having access to these funds for unexpected expenses can help reduce, the need to draw from your long-term saving investments. And this approach helps protect retirement savings from being used prematurely.
Definitely, and it's also important to remember that financial journeys vary widely across households. Some single workers build substantial savings through consistent planning and disciplined habits. Personal decisions and long-term commitment can strongly influence retirement readiness.
The key takeaway is that life circumstances can shape financial outcomes. However, individuals may still influence their long-term progress. Thoughtful planning and steady contributions can help strengthen your financial security.
And understanding how personal circumstances interact with financial habits can help individuals make more informed decisions. Reviewing saving strategies and adjusting when needed can support those long-term goals. Small improvements made consistently can lead to meaningful results over the course of time.
And working with a financial professional may also help to identify opportunities to strengthen a retirement strategy. Guidance can help provide perspective on contribution levels, investment approaches, and long-term planning considerations. A clear strategy can help individuals stay focused on their goals.
Retirement readiness is shaped by many factors, including income, expenses, and savings habits. While marital status may influence the path, consistent planning remains one of the most important elements of financial stability. Staying proactive can help individuals feel more prepared for the future.
Cole, I think that's all the time that we have for today.
That's right. Viewers, if you'd like help reviewing your retirement strategy or identifying ways to strengthen your savings plan, contact us at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this.
If you're 59 and a half or have recently changed jobs, now might be the perfect time to consider a 401k rollover. Rolling over your old 401ks could simplify your finances and give you more control from investment options and costs to how and when you make withdrawals. A rollover could give you the opportunity to partner with a financial services professional and tailor your investments to your specific needs, not the company's group plan. Call our office today to schedule your complimentary consultation and see if a 401k rollover is right for you.
With recent market changes, it's understandable that some people are feeling a little anxious about their financial future. That's why now might be a perfect time to review your financial plan. A financial services professional is trained to help you stay focused on the facts, not emotions, when it comes to your strategy. Getting a second opinion today works to ensure your investments are properly positioned to weather market volatility and that you're not taking on more risk than you realize. Let's work to make sure your plan is ready for whatever comes next. Call us today to schedule a complimentary review with one of our financial professionals.
Thank you for tuning into this week's edition of Financially Speaking. We're glad that you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way that we communicate to our clients when we meet with them in person. And remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your current retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV and radio show, or schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, give us a call at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and the same place for another episode of Financially Speaking.